That is certainly the most common question that's getting asked, because that's the concern anytime we go into a correction is it more than just a correction? Is it going to become a crash? Is the crash going to become a recession? Because stocks typically don't do well during a recession. So if we knew with certainty that we are in fact in or heading into a recession, you would not want to own stocks. So the fact that you're pointing out that certain economically sensitive sectors are already down over 20%, that does make it feel like we're in a recession. It's scary. It's just scary to see red whenever you turn on the business TV or you look at your portfolio, and especially with what you're pointing out, these are the sectors that would be doing poorly if we were in a recession. So it's impossible to know if anytime you're in a correction, especially when you're at the bottom of that particular correction, it feels horrible, and you're talking to people who are losing money. If they're people in our business, they're people who are overseeing portfolios that have gotten chopped, and the mood is dour. And I think it becomes increasingly difficult to keep perspective on what's actually happening with the economy. So the fact that those sectors are so far off their recent highs can't influence our view on whether or not we're in a recession. A recession is defined by having 2 consecutive quarters of negative GDP growth. That is not the case currently. Those stocks and sectors doing so poorly, it's not a good sign, that's for sure, but it doesn't necessarily mean that this is more than just a correction. Yeah, it's sort of like a perfect storm. All these things, I believe, are related. So obviously, interest rates have spiked dramatically this year. There are a handful of people that were calling for rates to move this much higher, but those same people were calling for higher interest rates for the last decade. So nobody with any credibility left accurately predicted this move in interest rates. So, and I think that is kind of connected to the inflation expectations. Rising interest rates are usually a sign that investors, fixed income investors, expect inflation to pick up. And we saw that leading up to Russia's invasion of the Ukraine. There was sort of 50 or 60 basis points higher in the 10-year Treasury from the start of the year until that invasion. And then it continued. Inflation expectations accelerated after Russia's invasion of Ukraine, which is probably connected to the fact that oil spiked for a very short period of time right after that. And all of this kind of leads into the fact that stocks have not yet found a bottom and started to recover. So bonds started falling right out of the gate to start the year and continued falling just as quickly after the invasion. And stocks have kind of done the same thing. They've sort of moved in unison this year, which is very unusual. And I think it is kind of like the damage on one side is compounding the damage on the other, because you've got so many portfolios now that are made up of stocks and bonds. You've got this 60-40 portfolio, 60% stocks, 40% bonds. That's sort of considered a relatively balanced portfolio. And when both sides are losing value, where do you go? And how do you cut losses when you don't have anything that's been counteracting what's losing? Bonds are supposed to be a flight to safety. And people are afraid of bonds because they think inflation is going to get out of control and interest rates are going to just keep moving higher. Why would I want to own bonds now? I can own bonds later when they're going to yield even more. Which sort of contradicts the recession claim, because if I'm afraid that we're going to go into a recession, then I'm afraid that growth is going to slow, stocks are probably going to do even worse, and you would think that bonds would be attracting some capital. And that's not happening. That doesn't necessarily mean we're not going into a recession, but I do think that those are two conflicting points. if the inflation data starts to be a little bit tamer and shows signs that we have peaked, maybe last quarter or even the quarter before, that would, I think, generally speaking, be good. That seems to be the largest concern for the market right now, and it's because the Fed is the most powerful force in the market right now, and they've basically pledged to squash inflation. So if inflation were to start showing signs that it didn't need any help from the Fed to slow it down, that would be a good thing for both stocks and bonds. First, for bonds, stocks would react immediately also, but just getting the Fed sort of out of the way of short-term interest rates, I think, I mean, I could make a guess that the yield curve would start to steepen. The short end would stop rising. It's already kind of stopped rising. Maybe it would come back down a little bit, because that is the part of the yield curve that anticipates what the Fed is going to do to the Fed funds rate. And I think that would also remove some fear about longer term growth, which would positively impact the long end of the yield curve. So all of this would be signs of a healthier economy, or an economy that is going to get healthier, which then, of course, would be good for stocks. So yeah, there's today's Tuesday, tomorrow's going to be this CPI print. The video won't have come out by then, but it is important, and it's theoretically possible that the number could be bad and the market could still react positively. We just don't know exactly what the Fed is prepared to do. We don't know what kind of language they're going to come out with. You know, again, last time they spoke, they hiked by 50 basis points, but they did try to reassure us that they're not looking to send us into a recession in order to tame inflation. So if that's the case, then you know, we have to kind of trust that they're not going to overdo this. So today I didn't see where we are after the close, but at one point today I saw 21 was the level, and below 20 is almost always a great entry point to put money to work. So we're right there. We're right at that level, and maybe we cross it tomorrow morning, or maybe we did cross it today intraday. I don't know exactly. But there's a bunch of other fear readings that are in the buy zone. The put-call ratio is one of them. The distance that we are from the 200-day moving average for small caps, technology, biotech, a bunch of major indices are far enough from their 200-day moving average that they indicate it's a good time to at least have a major short-term bounce. So, and sentiment is just wildly negative. I mean, you can't talk to anybody who's excited about putting money to work right now in anything. I saw somebody, a professional money manager today, say, "Where am I supposed to put money? I'm not putting it in bonds. I'm not putting it in stocks. I've got nowhere to allocate capital at the moment." So there's truth to that statement, because everything looks terrible. But then there's also this, the fact that the behavioral side of things, when sentiment gets that bad, where just nothing looks good, oftentimes that's when we see a huge reflexive bounce. So, and that's just all that could be is a bounce, but what happens after the bounce is what determines whether or not this was actually a bear market, which could lead to a recession, or just a garden variety, very, very painful correction. And I still think that it is a very, very painful correction. It sounds stupid to kind of repeat that, but I do still feel that way. You know, it does kind of feel like everyone is under the assumption that we are in a bear market, that we're headed towards a recession, and you know, there's no certainty. We could be. That always could be the case, and again, it could become self-fulfilling if there's just simply no stopping with the stock market dropping. Then yeah, we could find ourselves in a recession. But the fact that these growth names and the NASDAQ are in bear market territory, but nothing else is. None of the other broader indices have fallen that 20%. It's a magic 20% number equals a bear market. We're not at that level. So to call it a bear market, it feels bad because these commonly owned stocks are all down. And I don't know if it's a function of who owns them. The fact that Gen Y or Gen Z or who Gen Z owns a lot of these, and that's who you see on TV, and that's who you hear talking about stocks. I think it's just it affects the sentiment, and the sentiment is that we are in a bear market, but the data doesn't support that. And I think the fact that bonds are also down at the same time as stocks, just to give some quick back of the envelope math, let's say stocks were down 20 or even 25%, but bonds were behaving the way that they were supposed to. Your portfolio would be down about 15%, just using numbers, basic back of the envelope. That's where we are now, even if you own stocks and bonds. So it makes sense that it feels like a bear market. Everything's down, but nothing except the NASDAQ is actually down more than 20%. So I don't know if that supports the fact that we are simply in a growth scare, but it makes sense to me that sentiment has been influenced by other factors than just what's going on in the broad stock market. What could go right is that everything we're hearing about, everything that people are afraid of in this moment, that all of it is overblown. Every single thing that's being mentioned. The fears of inflation, and I think that's probably the most likely thing to correct itself in short order. Mm-hmm. People are putting a lot on this data point tomorrow, this CPI print, and it may be good, meaning lower than what people are fearing. So I think lower than 8% year over year is what people are hoping for. A lot of this stuff is so messy because of what happened in 2020. So part of the reason we had a negative GDP print in Q1 was because the GDP print in Q1 of 2020 was so bad that last year's was going to be obviously positive. These are year over year comparisons. So you're comparing these lumpy data sets. It's hard to interpret it accurately, I think. And but anyway, I think the inflation argument is probably the most important factor because that's being influenced by what's going on in Russia and Ukraine. The fears of inflation really spiked after that invasion. So if we start to see that subside a little bit, then we can potentially rule out the Fed as a wrecking ball that's going to crush inflation at all costs. And then we can start to focus on the fact that some of the companies that their stocks are down 30, 40, 50%. These are big, the new modern economy. Amazon, Google, Apple's not down nearly that much, but Facebook, Netflix, Microsoft, these companies they're part of what we do every single day. And their stocks have just gotten destroyed. Their numbers have not been that bad. Some of them are a little bit, they're guiding a little conservatively just because they don't know the outlook for the economy. But I don't think any of them deserve to be down as much as they are. So
Apple hasn't crashed. I mean,
no.
It seems to be the Apple, the bellwether of the market, has not crashed. And so, should I wait until Apple crashes? And is that the all clear to buy stocks at that point, or could the whole market crash or continue to crash? Whatever. Apple doesn't. Can that be an all clear, or does Apple need to crash to be an all clear?
If we waited for Apple to crash for a buy signal every time we had a correction, you would have not put any money to work over the last several years. Apple doesn't crash all the time, and Berkshire Hathaway owns a ton of Apple. Berkshire Hathaway hasn't crashed. So I think if everyone, quote unquote everyone, is waiting for Apple to crash to put money to work, they may not get that moment. Apple has corrected by the same amount as the S&P. You know, it's down 15, 16%. So, and also everything doesn't crash if we're not in a crash. If we're just in a correction, then I don't think you're going to have the opportunity to wait for Apple to crash. So I don't know if that answers the question. But what could go right? We find ourselves in this situation where a lot could go right because so much is perceived as wrong right now. You know, the fact that we're talking about not being able to find a single thing that looks appealing is, to me, that's a good thing.